And welcome to TerraPips. In today's video, we're going to be discussing the best way to trade the Deriv boom and crash in 2025. Now, I'll be teaching you the boom 500 pairs, which happens to be my favorite pairs ever since I've been trading the boom and crash and other synthetic indices. Now, this pair, let me quickly go and delete all the objects I have here. Now, this pair respects your zones a lot. If you know how to draw the zone perfectly well, it respects zone a lot. Now you want to head over to your 4-hour time frame. That is where you normally start out from, and obviously you know that the higher time frame zones tend to hold the market longer than the lower time frame zones. So usually as a day trader, I will normally start from the H4 time frame, where I look out for where the market is heading out to. And how can you determine that? It's by drawing zones. And when we say zones, it's not just a single line. You draw it in terms of a region, more like a zones where the market has respected in the past. And mind you, Deriv tends to offer you plenty zones, like zones more than enough. Now you have to look out for zones that have more touches. When we say more touches, zones that have been tested previously in the past, they have more rejections in the past in the market. Now when you draw out your zones, you watch out for your trend lines. Now you zoom out of the market so that you'll be able to see your trend lines, so that you can be able to draw your trend line very well. Now let me show you what I'm having here. If I look at this from this perspective, you see here, and to this point. Now there's something that Deriv normally does. If you're looking at a particular level, let's say at this point, you're looking at a particular level, you're expecting this market to reject here, and it did not reject. You understand? Now, what you should note that if there is a breakout like this, you can actually go back and back test. If there is a breakout like this in a zone, if this is a breakout in a zone, I can tell you that this market, once if there is a breakout, it's going to come back all the way down to the next level of support. If there is a breakout from a level where you're thinking it's going to resist the market and it did not, instead the market gave you a fake out at this point. It gave you a fake out here, and you've noticed that ever since this fake out happened, the market has been selling. It has been selling. You can go back and back test and see. Once if you have a fake out from a zone, if market is supposed to respect your zone, let's see, if the market is supposed to respect your zone and instead you now spot it as a fake out, see it here. You can see another example here. We're expecting this market to respect this zone and drop, but respect this zone and go up, and drop, but instead we had a fake out. It went up, and then this is your confidence that this market is going to start coming back down. So most people wait for a strong bearish candle and then make an entry, but I have a personal candle that I look out for. Once if I see that candle formed, I'll now stack up my sells all the way to the downside. But mostly, to be on the safer side, I would advise the next level of support, the next level of support. That's where I would advise you to take out your profit from and then leave the market, because you know you're trading against the spike. Now this goes for when you're trading against the spike, or you're intending to sell. Now the same thing is applicable for when you want to sell, when you want to buy the market. Now if you want to buy this market, all you need to do is to mark out your zones. Now the same way you saw me marking out these zones, all I need to do is, after marking out these zones, I'll just need to go over to my 1 hour time frame and look out for where, obviously the 1 hour time frame will give you a more broader zones. Like it shows you even zones that your 4 hours did not show you. So you can just draw out your trend lines from this point all the way to this point. So this is now a confirmation that, okay, obviously this market is going to fall to the downside. If at all you were doubting the 4 hour fake out, you can just go to the 1 hour time frame and look at it. You have a strong break of your trend line. Now from the break, you see we had a retest at this zone, this spike that gave us the retest. I think this spike here, that served as a retest. But if you're scared of the spike and you don't want to go in for a sell, you could actually just wait for this bearish candle to finish forming, and you can decide to take in your entries and catch out your spike, your sell all the way to the downside like this. And this is your TP. You guys can just maybe screenshot this and then check the video later on to see how the market sold all the way to the downside. Yep. So for the spike catching, if you want to catch spikes on this market, like I said, the market respects your spikes a lot. So we go back and back test. Respect your zones a lot. So we'll go back and back test so that you see what I'm saying. Let me pick my tool and then draw. We have this zone here. Now there's something the Deriv normally does. If a market is going to respect your zone and give you a strong push to the upside, you are going to always have fake outs. This doesn't happen always in the market. This particular setup you're seeing, this setup you're looking at, it doesn't happen always in the market. This level I'm tapping on, it doesn't happen like that in the market. Deriv have a history of playing around like this with the market. They can just decide to go like this and come in. You can just go like this and go up again. You might just feel, okay, I'm on a buy, it's going up. Then they will come all the way down to take out your stop loss, giving you that fake out the way I said, and then they'll now rally all the way back up to the upside. This is one of the things that Deriv have found of doing. Now let me back test it. Let me show you what I mean. Let's go. Okay, you see what I'm saying here? Okay. Let's see. This is a perfect example of what I just showed you. You see how the market went all the way. This is our zone. Market rejected, came back down. You might be on a buy at this point, and then they'll give you a spike. They'll give you a spike back to the upside. Now after giving you a spike back to the upside, you see you're excited that you're on a buy, market is going up, and then you see this strong reversal to the downside to now take out the stop losses, and then they will now head up to the upside. Now mind you, provided you see this fake out, I can tell you that if you make an entry again, your stop loss can come back and be here again. Like your stop loss can be somewhere here. The market will never come back to that point again. So if you want to even be on the safer side, just wait after this strong push. After this strong push, you just wait and then allow the market to come back to this point again. Take your buy, or if you don't want to be on the market for long, you can just place in your buy limit around here. Your buy limit can be here and your SL can just be here, and then you catch the market all the way to the upside. So basically guys, you can actually go over to the charts and backtest this. You can backtest everything I showed you here, but always keep in mind that the Deriv boom and crash pairs respect your zone a lot. That's if you know how to draw them. It respects the support and resistance zones. It respects the trend lines very, very well. Even if it's just spike that you want to catch, catching spikes on the 1 minute time frame does not help. I will tell you that based on my personal experience, it does not help a lot. Now, you can either use the 5 or 15 minutes time frame to make your entry to catch spikes once if you're able to draw your zones in the higher time frame. So thank you guys for watching this video, and I'll see you guys in the next one. Thank you.